Capital gains tax. It's a buzzword right now. And although it's trending, the correct explanation of what capital gains are and how they're taxed, unfortunately, is not trending as well. So, in this video, I'm going to briefly go over what capital gains are, long term versus short term capital gains, how they're taxed, and I'm going to even take a look at realized versus unrealized capital gains. But before I get into that, just in case you're new here, my name is Timbaland Bowens, and I'm America's favorite EA. I'm also the owner of Bowens Tax Solutions, which is a virtual firm based in Louisville, Kentucky, and we specialize in helping taxpayers just like you who are facing IRS debt of $100,000 or more, are being audited, or actively being levied. But because I believe in tax literacy and filling that gap one taxpayer at a time, I wanted to share this video to give some educational but also preventative measures. So let's get right into it. What is a capital gain? When we're looking at capital gains, we are looking at any profit that is made from the sale of stock, real estate, or any other type of asset. Okay? So, for example, let's say that you trade stocks. And when you purchase your stock, you paid $10 for each share. Well, if you turn around and sell it for $50 a share, there's a $40 difference. And that $40 difference is what we would call a capital gain. Now, with that, when we have short term gains versus long term gains, they are taxed differently. So, with a short term gain, that means that you held that asset for less than a year before you sold or disposed of it. Okay. If we're looking at a long term gain, that is going to be an asset that you held for more than a year before you disposed or sold it. And the reason this is important is because short term capital gains are going to be taxed differently than long term. So, with a short term capital gain, whatever tax bracket you're in is going to dictate how that's taxed because it's going to be taxed at your ordinary tax rate. All right. So, the perk of a long term capital gain, this asset that you've held for over a year, is going to be there are special tax rates. What does this mean? Even if you are in a higher tax bracket, you likely are going to be paying a lower rate on the long term capital gains. There are three different brackets for long term capital gains. And currently in 2024, those long term brackets are 0%. This is going to be for our taxpayers that are on the lower end of earning income, right? And have taxable income. The next bracket is going to be 15%, and then we have 20%. Now, again, just like with the short term, it depends on how much of the income is taxable, and then whatever the rest of the income is being taxed at, that's the same rate that the short term capital gain is going to be taxed at, unless the additional income from that short term capital gain makes the taxable income jump up enough to go into the next tax bracket. Now, with the long term capital gain, like I said, it's going to be our lower income earners that are only going to be graced with the 0%, essentially not being taxed on the gain at all. Then next, we have the 15% and the 20%. Now, part of why this is all a buzz during this election is because of a proposed plan to tax unrealized capital gains. Now, what does that look like? Let's go back to the example of you buying stock at $10, right? But right now it could sell for 50. So you don't actually realize the gain until you sell the asset. So although we're looking and you may be able to sell that share that you bought for $10 for 50, you don't realize the gain until it's sold and you get the $40, whether that's back in a brokerage account or you actually get sent a check. And then that's when it becomes taxable income. With this proposal, what would happen is there would be a cutoff date, right? And we would see when that cutoff date is what you could have sold that stock for. So let's say on the cutoff date, perhaps you could have sold the stock for $60. So there's a $50 unrealized gain, and it's unrealized because you didn't actually receive anything in a transaction because you have not sold it or disposed of it. Now, with this proposal, I'm not going to get all the way into it right now, but this tax would not apply to taxpayers who are under a certain amount of income. Now, the threshold is quite high, and there are a lot of people saying that, if you only make a certain amount of money, you shouldn't be concerned about it. I'm going to argue with that. I would say you should be aware of what's going on because although it may not directly impact you right now, it has potential to impact you later. Okay? If you have any questions or concerns, please feel free to drop them down in the comments below. And maybe you are fine or you will be fine when you file your 2024 tax return, but maybe you have a tax bill that you can't pay right now due to a capital gain on your taxes in the past. If that's you, I want to invite you to book a call with me and my team at Bowen's Tax Solutions. You can book a discovery call at www.bowenstaxsolutions.com, and I'll leave that link down below too. But here's the big thing, because remember, I'm filling the tax literacy gap one taxpayer at a time. Even if you don't give me a call, make sure that you still get the help that you need because back taxes shouldn't ruin your life.